Hello, in this presentation we will record an adjusting entry for an invoice or accounts receivable within QuickBooks Online. Here we will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. We are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're doing adjusting entries here. These are going to be the entries at the end of the time period that we're going to enter in order to be more on an accrual basis, in order to have the financial statements correct as of the point in time that we're going to issue the financials, typically the end of the month or the end of the year. For us, the end of the month of February. What we're going to have is the idea of an invoice that has been entered, but we need to pull it back to the date in which the work was actually done. And to see that, let's take a look at first the balance sheet report. We're going to go to the reports on the left side. We're going to look to the balance sheet, selecting the balance sheet. We're going to select the date ranges of 01/01/21 to 02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. We're going to say that we're going to issue our financial statements as of February 28th, the end of this month, and therefore this is our cutoff date. We want to make everything right, as close to an accrual basis as possible, to make the best decision making on it and to be able to provide the most correct numbers as of this point in time. So these are going to be the adjusting entries in order to do that. What we're saying now is there's going to be an adjusting entry related to an invoice, which one account affected will be accounts receivable. We're going to say that the invoice went out in March. However, it should have gone out in February. And let's kind of look at the scenario in terms of the drop down here to walk through what could be happening through an invoice and why this might happen. So we're going to select the plus icon up top. Looking at the customers over here, we have the normal process of what's going to happen. We have an invoice and then we receive payment. And clearly the invoice happens when we do work, typically. So if we think about a service company, oftentimes if you're thinking about a law firm, a CPA firm, any kind of company that's going to provide work and then invoice the client, it's quite possible that we are not going to get around to the billing of the work for every 2 weeks, meaning we might do work for a week or 2 weeks and then have to collect everybody's hours in the office and create an invoice based on the hours that were worked. And that means that the point in time that we create the invoice, we're imagining our cutoff date here being the end of February. It's quite possible that the work was done in February and we didn't collect the work because of the 2-week time period it takes for us to, before we do our billing process. Our billing process could have happened sometime in March. So in this case, we're saying, well, the work happened in February. The invoice went out in March. So to be on a perfectly accrual basis, that's not exactly correct. What we would want to see is everything that is done in February be billed in February. So note that QuickBooks records revenue when the invoice is created, which is closer to an accrual basis than when cash happens. However, it's not perfect. It's just still a convention that the system has to use something to trigger that time period, and the invoice is what's used. So because it's still not perfect, we got to go in there and fix any kind of problems like this, like the invoice was created after the cutoff date, even though the work was done before the cutoff date. So to further illustrate that, what we'll do is we'll actually create the invoice. And we're going to create the invoice not for the month that we're working on, but for the time period after. We're going to create the invoice for March for work that was completed in February. And then we'll see how we're going to adjust for that. So to do that, we're going to go to the plus icon up top. We're going to go to an invoice. And we're going to create a normal invoice. And it's going to be for Sam the Guitar Man. So I'm going to select the drop down, type in Sam. And there we have the invoice. We're going to scroll through this. We've done a few invoices, so I'm not going to spend a lot of time on the creation of the invoice. We're going to add an address down here because the address is going to help us to calculate the sales tax. Now, obviously, I'm not being consistent with the addresses here because I'm really only adding them in order to help us calculate the sales tax. So we've got to have some type of address and set up the sales tax for that particular location for the sales tax to be calculated. And then we can adjust for that after it's been calculated. Okay, so we're going to say net 30. We're going to say that the invoice date is going to be sometime in March. So let's make it 03/02/21. Let's do that one more time. Oh, what happened there? 03/02/21. So that's March 2nd. Let's make it the 3rd. Just make it the 3rd. March 3rd, 2021. So that's the month after. So we're issuing this invoice the month after the cutoff date. But we're going to say that it actually happened before that time period. So it happened in March. We're going to sell, in this case, a guitar. Now, I talked about a service kind of item. And I think that makes a lot of sense for most people when they think about, oh yeah, the billing process is always going to take, some time after the work was actually done. We're going to use an inventory, however, because that'll give us a little bit more complex journal entry to do a reversing journal entry on, and so because we'll have to deal with cost of goods sold and inventory. Now the inventory, the same thing could happen. So for whatever reason, if we look at the shipping document, which is usually the driving document as to when the product changed hands, and the shipping didn't actually happen, the shipping actually happened in March, even though the invoice wasn't, in February, even though the invoice wasn't issued until March, then the same thing is the case. If the shipping document shows that it happened, we actually delivered the guitar in the month before the cutoff, which is February, and then we didn't invoice until this March, then we should really pull that back. And that's what we're going to be doing here. And this is kind of like you could think of this as a typical kind of audit procedure as well as an adjusting type procedure. We look at those invoices that have gone out the first few days after the cutoff date, and then check the shipping documents, the documents that would show when the actual revenue should have been earned in accordance to revenue recognition principle, and then make any adjusting entries as we'll do here for that amounts. So this is going to be an ELP. It's going to be an Epiphone Les Paul, one of those, and $500. And if I click off of it, it should then calculate the sales tax, hopefully down here. So there we go. There's the sales tax. Now remember, we're just going to be using a simplified just 5% sales tax because we want to make this problem kind of universal. Remember, sales tax, all you do on sales tax or usage tax is take the amount and then multiply it times whatever rate that whatever taxing authority you're dealing with is making you charge on it. So we're going to take 500, in our case 5%. Nice, kind of not exactly even, but nice standard rate. So we're going to say $25. $25 is the sales tax. We're going to say yes, that's okay. We want to keep that. Other, it's going to be a practice problem. So we'll tell QuickBooks that, and there we go. Okay, so here's our total, 525 that we have down here. So remember, if we look at this invoice, we'll take a look at it, but it's good to think about it whenever we record anything. The invoice is going to increase the accounts receivable by 525. It's going to increase revenue, but only by 500. It's going to increase the payable, the difference of the $25, which is a liability, and it's going to have a cost of goods sold for an amount for this guitar, but not the retail 500, some other price will be the cost of goods sold and the reduction of the guitar inventory by, once again, not the 500, but something other than this, like 400, I believe, is going to be what the cost of it. So let's save this, and then we'll take a look at this. So I'm going to close this back out. We're going to go back to our reports. Now this report, we're gonna see the report for the month after our cutoff date. So I want 03/01/21 to 03/31/21. So the month after, this is March. This is when that invoice was entered. And if we scroll down, we've got accounts receivable. If we select accounts receivable, we see this invoice. So this is the invoice that went in there after the cutoff date, and we think it should not be in March. We think it should be pulled in to February because that's when the actual guitar was shipped. So if we go back to our report, the other side of that is going to be on the income statement, but we'll look at the liability as well. We'll look at everything on the balance sheet. and that's going to be the California State Board of Equalization, because we owe the sales tax. So if we select that item, it's a liability, we see this adds up to the 25 that we saw on our invoice. And then if we go back one more time, we're going to go back. We also have the inventory going down. So if we scroll up to the inventory, and here's the inventory asset. If we select that item, then here's our invoice again, and it's reducing the inventory by 400. Remember, that's not on the invoice. If I select the invoice, that's not on the invoice. It was 500, but the cost was 400, and we'd know that by looking up the item to see what the cost was. We're going to close that back out, and we'll take a look at the other side, going back to reports, to the profit and loss side of this. So we'll go to the profit and loss, and we're going to type in the dates of March 03/01/21 to 03/31/21. So this is the month after the report, our cutoff date of February 28th, and we will run that report. And then here's our 500 again. There's the 500, and that's our invoice that's creating it, going back to the report. And then there's the related cost of 400, cost of goods sold. That'll be the same invoice. So what we earned on this was, of course, 500 went up, and then 400 went up in the cost of goods sold, bringing the net income up by the net of $100. So this $100 then, this 500 revenue and this 400 is an amount that should be in the prior month. It should have happened before the cutoff. So what we need to do is we're going to enter a journal entry that kind of mimics this invoice. That'll be the same thing as this invoice before the cutoff to make it correct. Now, when we do that, the reason we're doing that is because this 500 should be in the prior period. Now, you might be saying, well, why don't we just change the date of the invoice? Typically, we don't want to change the date of the invoice because it'll kind of mess up the normal accounting process. For example, if it was a billing cycle that we had, and the billing cycle happens every 2 weeks, we don't really want to mess with that cycle. That cycle works, and that's part of the cycle. There's nothing wrong with that. Nothing actually went wrong. It's just that we're going to make an adjusting entry to be more an accrual at the end. So there's kind of two things that happen: the logistics of just the bookkeeping, and then us going in and make any adjustments to the system in order to make them right in accordance with accrual principles as of the end of the time period. So we're just going to basically record this again, but with a journal entry as of the cutoff date to put that 500 back in before the day before March, which will be there on our financial statements as we believe it should, because that's when the revenue was actually earned. And then, of course, we'll have to do a reversing entry because we'll have that in there 2 times. So that's what we're going to do now. We're just basically going to repeat. We're going to repeat what we did exactly on this invoice, but we're going to do it with a journal entry. Now, typically, before we did some information, we did some of this stuff with a register, but this one's a bit complex of a journal entry, so there's not much we can do to get around the fact that we're just going to have to enter the journal entry. So we're going to use debits and credits this time. So I'm going to select this item up top. We're going to go down to the other. We're going to go down to the journal entry. And we're just going to record this exact journal entry we had, but we have to do it as of the cutoff date. So it's going to be 02/28/21. That's the end of the month we're working at. And we're going to enter this information. So remember, this is going to be the journal entry. This will be what a journal entry is when we create an invoice. So this will give us a better idea of what an invoice is doing. We're just basically recording the invoice again, but with a journal entry. So when we record an invoice, accounts receivable goes up. So I'm going to select the drop down and or type in accounts receivable. And that's going to be a debit balance. So it's going to go up with a debit because accounts receivable is a debit balance. And to make it go up, we do the same thing to it, which is a debit. So that's going to be 500. And we're going to say I'm just going to call it an adjusting entry. And we do need a name here because if we don't have a name, then QuickBooks will not let us record to accounts receivable because it won't be able to, without a name, create the subsidiary ledger, meaning tell us who we owe by, basically the accounts receivable represents people owing us money. And the system wants to make that subsidiary report telling us who owes us money. And it won't be able to do that unless we have a customer name. So we have to have something here, even though it's just an adjusting entry. And our customer was Sam the Guitar Man. So we're going to type in Sam the Guitar Man. And the other side of that, we have accounts receivable. And then typically we have sales or revenue. That's going to be the other side of this. So I'm going to call it sales or revenue. I believe we called it sales of product income. So we'll select that item. And actually this amount here was 500 was the sales price, and then it was 25 was the sales tax. So it's 525. This item here, however, was only 500 because that's the sales price, and it increased with a credit because revenue always has a credit, and so we just increased it with a credit. And we don't need a name there because sales doesn't need to be applied out for the use of a subsidiary ledger. And then the difference is going to go to sales tax payable. So if we can select that, we can find that in the drop down. It's going to be a liability account. And here it is, it's the California Board of Equalization because that's who we're paying our sales tax to. That's going to be the 25. And that would be it if, if it was a service company basically. But we also have the cost of goods sold and the inventory to deal with. So we're going to say that the cost of goods sold, which is an expense, cost of goods sold here is going to be for the $400 amount, as we saw. It wasn't on the invoice, but we went and saw it when we recorded that invoice, 400. And then we have the inventory is going down. So this is going to be the inventory. It's an asset. It's going to go down by 400. So here's our journal. So you can see that this is what's really being recorded every time we make an invoice. And it's a bit more complicated than you might think on first glance. So we've got accounts receivable, which is an asset. Assets have debit balances. It's going up because people owe us more money, but by the full amount of the invoice, $525. Then we've got the revenue. Revenue is a credit balance account, and it goes up with a credit. So we go up by doing the same thing to it as its normal balance. So it's a credit, and we're going to credit it again, making it increase by the 500. The difference between the two is the sales tax that we collected. Sales tax is going to be a liability account payable. It's California Tax Board payable, which is sales tax payable. That's who we owe. And it has a credit balance because it's a liability. We do the same thing to it to make it go up, which is a credit. And then we have the cost of goods sold, which is the expense related to us consuming the guitar. So you can think of the income statement accounts as being the sales and the expense. So this went up in terms of revenue. This is an expense that's going to go up. The net of the two is going to be the net increase, the net income, which is going to be what we got for it minus what we purchased it for of the 400. It's a debit balance because it's an expense and it only goes up in the debit direction, so we're increasing it with a debit. And then we've got the inventory, which is an asset account, and it's got to go down because we gave away the guitar, and therefore we're going to do the opposite thing to it as its normal balance, which is a credit. Okay, so we're going to see if we can record this. It might tell, if we didn't have this name here, it would say that we couldn't record it because we don't have a name. It might require us to have a name here because this is a type of a payable account. We might want to list. Let's go ahead and see. We'll say save, and it's going to say, oh, it did record that, so we're good. So now let's go through this, and we recorded this as of 2/28 and see what happens. So I'm going to close this back out, and we're going to go back to our report. Let's go to the balance sheet first, and we're going to go to reports on the left. We're going to go to the balance sheet, and we're going to select our balance sheet as of 02/28/21 and 02/28/21. Let's make it 01/01/21. So January 1st, 2021 to February 28th, 2021. And then we will run that report. So here's the report we have. So if we go through this, once again, the accounts receivable should have gone up with a journal entry now. So if we select that item, and we scroll down, we should see as of the 31st, we have our adjusting entry. Here's our adjusting entry. And if we use journal entries, it's nice in QuickBooks because then it'll give us that a journal entry format. Whereas if I just entered an invoice, it wouldn't differentiate that it's an adjusting entry. So here is the amount. And if we select that item, of course, then we go to our adjusting entry. So I'm going to close this back out. And note that if we change this date range to the end date of this transaction report to 03/31/21 and run that report, and we scroll down, we're then going to see the fact that we have this basically in there twice. It's here now in March, and it's here in February. So this makes it correct as of the end of February, but as of March 3rd, it's going to be in there 2 times. And that, of course, is a problem. Not a problem for our financial statements as of the end of February, but it means that we're going to have to do something, and that means we're going to have to reverse this as of the first day after our cutoff date. That's how we're going to deal with this. We'll do that later, however, because right now we're just worried about getting our financial statements correct as of the cutoff date. So we're going to scroll back up. We're going to take a look at the other side of this. Let's go to the reports and go to the profit and loss. So reports, profit and loss report. We're going to change those dates once again to 01/01/21 to 02/28/21 and run that report. We scroll down, we have the sales or product income. If we select that item, we should see our adjusting entry right there. There's our adjusting entry. It's increasing by 500, not the 525, because it's just the sales amount, not including the sales tax. And once again, if we change this transaction report, I'm just going to hit the plus arrow a couple times to the 3rd, then run that report. We will see that we'll have that in there 2 times. So same scenario, we're correct as of February, at the end of February, but as of March 3rd, it's in there 2 times, and we're going to have to adjust for that. We're going to have to reverse, in essence, this entry in order to do that, in order to make that adjustment. So we're going to scroll back up. We're going to go back to the report. And then we're going to go look at the cost of goods sold. If we select that item, scroll down, here's our adjusting entry. It's got the 400 in it. And that, of course, is our journal entry. Again, our adjusting journal entry. If we select that, here's our adjusting journal entry. And if we increase the date range once again up top to March 3rd, run that report. We scroll back down and we see that we have it in there 2 times. So it's not wrong to have it in there 2 times. It's correct as of the end of March because it should have been in March. So we pulled it back into March. But now it's going to be in there 2 times as of the end of we pulled it back into February. Sorry, we pulled it back into February from March. And then it's going to be in there 2 times as of March. So the financials are right as of the end of February. And then we're going to have to reverse it as of the first day of the next month so that it doesn't double up. Because this is fine for our normal purposes to just record it in March in accordance with our normal process. But it's not exactly generally accepted accounting principles. So we want to keep the 2 things separate. We want to keep the accounting department to do their normal cycle to record the invoices as they normally do with their process and just make the tweaks that we need to make when we're actually reporting formally our financial statements. So then we're going to go back here one more time. And if we take the difference, and now let's look at the last piece, which is going to be on the balance sheet. So here we know that sales went up by 500, cost of goods sold went up by 400, and the difference is 100. So the difference is an increase to the report, the net income that we are reporting on for this time period, February, here. So that's going to be our adjustment. We'll go back to the reports on the left side and take a look at the other 2 components in the balance sheet. And change dates from 01/01/21 to 02/28/21, January 1st, 2021 to February 28th, 2021, and run that report. If we scroll through this report, then the other sides of this is going to be the liability. Liability is going to be the California State Board of Equalization. Selecting that item, we owe, if we scroll down, it's going to be made up of this amount here, the 25 If we select that, that is our adjusting entry here. If we close that back out and we go back to our report, the last piece is going to be the inventory. So the inventory is going to be an asset up here. Here's the inventory asset. If we select the inventory asset and we scroll down, we see our adjusting entry here for the 400. So if we select that item, it's not the sales amount, it's the cost of goods sold that we have there. So if we close that back out, that's going to be it. So we've done a journal entry pulling this information and go back to the report into our financial statements as of the cutoff date. And note, of course, it's going to be perfect for us right here. And this is kind of the problem between the adjusting kind of department and the normal processing department. As of the financial statements, the adjusting department says, hey, we're good. The financial statements are correct as of 2/28. But if we don't do anything to kind of make it go back to fix it back to the normal just processing system for the normal accounting process, we're going to run into problems because it'll be recorded 2 times. And we'll deal with a reversing entry process, which is one way to deal with that process at a later presentation.